Welcome back to the deep dive. When you see a company's financial report, how much faith can you really put in it if it's just them saying it's okay?
That's exactly the problem audits solve. They bring in that independent check.
Right. We've covered some basics before, so today let's really get into the nitty-gritty of what an audit is and why it matters so much.
Okay, so fundamentally, the main purpose of a financial statement audit is, well, it's about the auditor giving an opinion
An opinion on.
on whether those financial statements are presented fairly in all the important ways,
Hmm.
materially according to the rules, the applicable financial reporting framework.
Okay, that framework, that's the accounting rule book, essentially, like US GAAP or maybe IFRS. Our sources mentioned those.
Exactly. Those are the big ones. Or sometimes it might be a more specific, tailored framework, depending on the company or why they need the report.
Got it. So the framework sets the standard.
Mm-hmm. And the auditor's report, their opinion, adds that layer of credibility. It's independent, it's unbiased, unlike potentially the company itself.
Yeah, without that independent look, you can see why public trust would just, well, evaporate.
Absolutely. It really boils down to who does what.
So management handles preparing the actual financial statements.
Correct. That's their job. Then the independent auditor comes in, does their work, and gives their opinion on those statements.
Okay, let's break down management's side first. It's more than just crunching the numbers, right?
Oh, definitely. They're responsible for the fair presentation, according to that framework we mentioned.
Yeah.
They need to pick the right one, use it properly, and describe it clearly.
And crucially, they also have to design and implement internal controls.
Yes, those internal checks and balances.
Yeah.
They need controls that are good enough to prevent or at least detect material misstatements, whether they're honest mistakes or outright fraud.
Seems pretty fundamental.
It is. And one more thing for management. They have to give the auditor access.
Access to what?
Everything they need, basically.
Yeah.
All the records, documentation, other information, and access to people within the company. Can't audit what you can't see.
Makes sense. Okay, so what about the auditors? What are their main responsibilities once they get that access?
Well, number one is expressing that opinion we talked about
Mm.
based on their audit findings.
But how do they get there? It's not just ticking boxes, is it?
Not at all. A huge part is maintaining professional skepticism.
Skepticism? Like being cynical?
No, not quite cynical. More like having a questioning mind.
Hmm.
Being alert to anything that looks contradictory or documents that seem, questionable.
Hmm.
Looking out for signs of potential fraud.
So not assuming management is dishonest, but also not assuming they're infallible either.
Precisely. You have to be alert. It can be tough sometimes. Things like unconscious bias or maybe trusting management too much can get in the way.
I can imagine workload pressures too.
Sure, but skepticism is core. Alongside that, auditors absolutely must comply with ethical requirements. Independence is paramount.
Independent in fact and in appearance.
Both. Needs to be real and needs to look real to outsiders. Think AICPA Code of Professional Conduct, other regulations too.
Okay, and they need professional judgment.
Constantly.
Yeah.
Throughout the whole audit, they're making judgment calls on things like materiality.
Ah, materiality again. So deciding if an error is big enough to actually matter to someone reading the statements?
Exactly. Is it significant enough to influence a decision? They also use judgment in assessing audit risk, deciding which procedures to perform, how many items to test.
Evaluating the evidence they find.
Right, and evaluating management's own judgments and estimates. Then finally, drawing reasonable conclusions based on all that evidence.
And they need enough appropriate evidence, right? Sufficient and appropriate.
That's the standard, and the whole thing needs to be done following Generally Accepted Auditing Standards, GS. That's the playbook for auditors in the U.S.
Are there other standards?
Oh, yeah. Depending on the engagement, you might have PCAOB standards for public companies, ERISA for employee benefit plans, ISAs internationally, GAGAs for government audits. It varies.
Okay. Now, our materials kept mentioning reasonable assurance. What does that actually mean? It doesn't sound like a guarantee.
It's definitely not. Reasonable assurance is a high level of assurance, but it's not absolute. Think of it as very confident, but not 100% certain.
Why not absolute? Why can't they guarantee the statements are perfect?
Well, there are inherent limitations built into the whole process.
Like what?
For one, the nature of financial reporting itself. It involves judgment, subjectivity, estimations. Think about accounting for bad debts or warranty costs. It's not always black and white.
Okay, so some uncertainty is just baked into the numbers themselves.
Exactly. Then there's the nature of audit procedures. Auditors test samples, not every single transaction. It's usually just not feasible.
And fraud.
Fraud can be deliberately hidden, sometimes very cleverly. Collusion, forged documents. Auditors aren't forensic investigators with, legal powers to compel testimony like police.
Right. They can only work with what they're given or can find through their procedures.
hmm And finally, there's timeliness and cost benefit. An audit needs to be done within a reasonable time and at a reasonable cost. You can't spend infinite resources checking every last detail.
So they have to be efficient, focus on risky areas, use testing. It's a balance.
It is. Effective planning is key. And remember, audits can differ in scope, too.
How so?
You can audit a single year or multiple years. You can audit the complete set of financial statements or just one specific statement, like the balance sheet, or even just an element, like accounts receivable.
And I saw something about integrated audits.
Right. For public companies, issuers, the audit usually must be integrated, meaning they audit both the financial statements and the effectiveness of the company's internal control over financial reporting. Non-issuers can choose this, but it's not typically required.
Interesting. Lots of different flavors of audit.
And specific ones too, like ERISA audits for retirement plans, which have their own particular objectives.
Okay, so wrapping this up, this deep dive really shows an audit isn't some magic bullet guarantee.
No, definitely not.
It's a structured process. It gives users, investors, lenders, regulators, a reasonable level of confidence that the financial statements aren't materially misstated.
Exactly. It's built on clear roles that crucial professional skepticism, professional judgment, ethical conduct, and gathering enough good evidence.
Understanding those inherent limitations is key, though. It's assurance, not absolute certainty.
That's the crucial takeaway. Which leads to maybe a final thought for you listening.
Go on.
Given that audits have these limitations, what specific part of the process, maybe the auditor's skepticism, the internal control testing, the independence rules, what gives you the most confidence when you look at an audited financial report?
That's a good question. Something to chew on. Maybe digging into how auditors actually assess risk could be interesting.
Or the role of oversight bodies, like the PCAOB? Lots more to explore there.